Yeah, we were actually scheduled to come over here maybe 2 years ago, and I got rescheduled a couple of times. So I'm delighted to be here to speak with you. I think just to kick off that, I only have 20 minutes. I will probably keep to the clock, and if you have any questions, I will be here all day at our stand. So feel free to come to speak with me if you have any follow-up questions. So what I would kick off to talk to you today about is like high conviction investing. I'm sure many of you do run your own portfolio, trading your own stocks, etc. And then that's something also we do as well. And I think there's something that I want to share from professional investor perspective, how we think value could be added in terms of doing research, etc. And then I would talk about a few things that we don't think is going to work if you go through other routes. But before I kick off, I thought maybe I'd just give you a bit of a recap of who we are, in case that you haven't followed us before. So the business was started back in 2016 between Peter Hargreaves and myself. I myself started my career at Hargreaves Lansdowne Bristol in early 2000. That's when Peter and myself met. At the time, I was there for 5 years. Then I came to London to work for a manager called Tim Steer at Newside Asset Management, and followed by Artemis Investment Management. And then in 2014, I joined Nevsky Capital, working with Martin Taylor, running a global long-short hedge fund. And 16 was the year that Peter and I decided to do something ourselves. And we have been talking about this Blue Whale for a few years beforehand. And I think that's when we first started. And I think the host rightly mentioned that Peter seeded the fund with £25 million 4 years ago, and then we're now grown over £1 billion in total. And I think if you see Peter's disclosure about a few months ago that his stake is now worth about 200 million, he's put in a bit more money over time as well. So I will come back to some of these points later. So that's the strategy that we do. We run a high conviction mandate, focus on developed market, large cap companies. The average market cap of our company are over £100 billion, so they're a really big company. If you have a copy of the fact sheet, that you will be able to see some of the companies that we have. At the moment, the top 10 holdings account for about 60% of the fund, so it's quite concentrated in a way. And in total, we have 25 stocks in the fund today, so the other 15 stocks would account for another 40% of the fund. The other thing, just to look on this slide, is this is a long-only fund, it's not a hedge fund, so we compare ourselves versus let's say the market, as in maybe MSCI World Index or IA Global if you're invested into other global funds. And that's the team, the 5 of us on the team, philosophy, very straightforward, high-quality businesses at an attractive price, and then we try to find the best ideas across the world in the developed market space. So here's what I'm going to talk to you about today, is so what are we trying to do and what we're not trying to do. So I think there's a few things that used to work quite well. It's about brokers research or sell-side analysts. If you have very good connection with investment bank, etc., then you will be able to speak with them, or you have some corporate assets, etc. But I think one thing that have changed over the years is I think the value that sell-side research could add to a fund manager or investor has come down dramatically because of the efficiency in the market, because of the changes in MiFID II, because the sell-side analyst typically would have different agenda, because the research that you see is quite generic. It caters for every single investors around the world with different investment philosophy, different time horizon. You might be a hedge fund trading quarters, you might be a long-only fund like us that takes a 3 to 5 year view, and value investor, growth investor, etc. But you only see one piece of research. And the other thing about sell-side research is I have enormous respect for the people who actually do it. So the financial analysts, they are really good. But it's just the output of the product in itself, it doesn't actually give you any edge as an investor. Because the other question we have to ask is, if we want to do better than the market, which means our competitors, our research can't be based on some piece of research that are readily available to our competitors, because everyone will have access to the research. And so I think that is something that we don't do. So at Blue Whale, we do all the research in-house. And I will come back to that in a minute. So we don't speak to any sell-side analysts. We don't read their reports, and then we do everything in-house between the 5 of us. The other thing here, which I'm sure some of you would know this already, is a lot of people talk about let's say the value and growth debate, talk about, oh, this stock is really cheap, it's trading at 10 times, 15 times, oh, there's another stock trading at 25 times, 30 times, oh, that's more expensive. We want to buy the stock that's trading at a cheaper, let's say, P ratio at 15 times rather than 25 times. But what people sometimes don't realize is the number that is out there, the headline valuation ratio, is typically based on market consensus. So you're talking about like a collective, or let's say, I don't know, 10, 15 analysts forecasting how much money this company is going to make in the next 2 years. So let's say if the number is £100, this company is going to deliver £100 of earnings. If you look at the PE ratio over a 2-year period, then that 15 times or 25 times is based on £100 of earnings. But let's say if you have done the work yourself, like we do, and then we actually expect this company to deliver £120 of earnings rather than 100. So then if the P ratio, the headline P ratio that we quoted is trading at 25 times, it could actually be 20 times because the actual number from the company is 120, not 100. Vice versa, if you have a company trading at 15 times, the market expects this company to deliver £100 of earnings, but let's say based on our research, assuming that we are right, that we come up with a number at $80 rather than 100, then maybe that company is not trading at 15 times, it's actually 20 times, right? So I think that's something you need to be a bit careful when you say, oh, let's do maybe a quantitative screening, let's find the cheapest company on a P ratio, etc. I mean, that is not the real number, it's just a projected number by the sell-side analysts, and you need to do your own work on that. And I think that is something that you would be able to have an edge over time if you do it right versus the rest of the market. So the last thing I want to talk about here in terms of what have evolved over the years, the reason why maybe headline valuation metrics doesn't work anymore, in contrast to be back in the old days, or maybe sell-side research don't work anymore, is because the market has become increasingly efficient day by day. So when I started my career over 20 years ago, I think some of the stuff that I just outlined could actually add a lot of value, because like you can't Google around, there's no Google, like we probably don't have our smartphone. But nowadays, I think the information is readily available if you invest into large company. We're not talking about small cap or unquoted companies here. Like we get, I mean, as a professional manager, like we would receive the news flow at the same time as any one of you at home. Like it's the same time. Like we do not have an advantage in terms of like, oh, we can analyze the information quicker than some of you here. We receive the same information at the same time, and the market has just become a lot more efficient over the years. And this is one of those things, like if you look back, I mean, I'm not here to talk about macro, but just to give you some high-level take on this, if you look back on a global financial crisis, if anyone still remember that, I mean, I was working at New Start at the time, and it took a long time for the regulator and also the central banks, the government, to do anything about the Lehman blowout, basically. And then the money then got to the economy a lot later, and then we had a massive recession for a long time. And if you recall what happened about 2 years ago when we had the pandemic, which led to a recession, a lot of effort has been much more coordinated in a very speedy manner, like a lot of money. I mean, the government just churned out so much money, just give everyone a paycheck. The central bank just cut rates completely and then have the quantitative easing, etc. And then the other thing, which I'm not here to talk about Russia, is the same thing. I think we definitely don't like to see what's going on in Russia or Ukraine. But I think if you follow what's going on, the uncoordinated effort by the Western companies to sanction, to make Russia to turn Russia into a third world country has been very fast. Like there's no committee meeting to say, oh, what we should do about this. And so hopefully with all this effort by different parties, that maybe the crisis or conflict could end a bit sooner. And I think that is something that happened in the market. And if you talk about the financial market, which is a different game to the economic cycle, a recession or economic boom, is like people would talk about, oh, is that a bear market? What is a bear market? I think back in the old days, we would talk about like a bear market for 3 years, maybe back in the early 2000s when we had the tech bubble. But then it took, I don't know how many years before like NASDAQ returned to its peak at the time. But then nowadays, the market's very efficient. There's a lot of expectation has been priced in, the worst case scenario, the interest rate expectations, et cetera, et cetera. A lot of this already have translated into the share price. So we're not calling a bottom here in terms of when the market is going to recover. But what I'm saying is I do not underestimate how how efficient the market could be. It's not like for like. You can't just take the history and say it's going to repeat. It's the same period. I mean, for a certain company, if their fundamentals are really weak, I mean, you will not expect them to recover. But we can come back to that later. So if I tie you back now, so what do we actually do to counter some of the challenges that I outlined earlier? I think the first thing is that we invest into really high quality businesses. I think if you do look at our top 10, you'll probably figure out what I meant by that. And I think if you end up investing into really high quality businesses, you have less things to worry about. So for example, like if I take Microsoft as an example, which everyone would know or maybe a user of, that they are good. Firstly, they're going to increase prices by about 15 to 20% next quarter. If you are Office 365 subscribers, which most businesses would be, that there's no way to get out of this loop here. Like you have to pay it, otherwise you have to change your entire like Office system, like the Outlook, the Excel, the spreadsheet, the Teams, if you use that. And then secondly, if you worry about inflation, like there's two things to tackle inflation. One is pricing power, the other one is the gross margin. So you have a different spectrum of pricing power. You would have Microsoft can raise prices by 15 to 20%, but then you have like consumer staples company like Unilever raise price by 3 to 4%. So spectrum's different. But how is that translate into earnings is the gross margin. If you have a low gross margin business, which means the majority of your revenue line are going to pay to external suppliers, then even you have the price increases, it's not going to be enough to offset that. So for example, the FTSE 100 companies combined on an aggregated basis, the gross margin is about 30%. So 70% of the revenue from the FTSE 100 companies combined is external, like they don't actually own it. So the gross margin is very low. For Unilever, for the world stock market, for Amazon, it's about 40%. So still 60% of that is external that you don't control. But for the likes of Microsoft, it's 70%. So only 30% of the revenue line is paid to external suppliers. And then you have the significant pricing power, 15 to 20%. So what you would expect under inflationary scenario is like Microsoft margin could actually expand. In contrast to consumer staples company, which I'm sure many of you follow, that they have, even though that they manage to raise prices, but their margin are actually coming down over the next few years. So I think that's very important to go into really high quality businesses that over time, some of this issue they would be able to resolve, and at the same time is subscription, recurring revenue stream, not much exposure to Russia and all this conflict, etc. So I think that is how you think about, like, if you are into high quality businesses, that's less things for you to worry about, which is what we're trying to do. The other, and this is how we go about doing the research to come to that conclusion is, I already mentioned that we don't use any broker's research. There are 5 of us on the team. We just go through all the primary sources that's readily available to us and to yourself as well, and then just try to formulate a good conclusion. And I have given this example before, if you heard this before, that like typically I think in a professional environment that it is quite typical that you might have only 2 people working, like being a fund manager or maybe a fund manager with an analyst covering quite a few stocks. Let's say 75 stocks in total between the 2 individuals, which I did before in my previous career. But then what you ended up with is you don't have enough time to do your research. So if you do a bit of a calculation, let's say each one of us, the 2 of us, work 10 hours a day. We cover 75 stocks in the fund invested. And then on average, we will end up spending about 5 hours per month per holding. That's how much time we have between the 2 of us, just looking at the 75 stocks. So there's no time to come to a master investor show to talk to you about what we do. And that is how much you have. So what happened when you only have 5 hours? Like you read the annual report, which we do. The same, you speak with the management team, which we do. You read, and then you ended up being quite dependent to brokers' research because you don't have the time to do the nitty-gritty. You don't have time to read 5 annual report. And what we have at Blue Whale, which is when we first started, there were 4 of us on the investment team. Now we have grown a bit bigger, now 5 of us. We cover on average about 25 stocks in the fund. 5 of us, 10 hours a day. On average, we could spend about 40 hours per holding per month. So what is the difference between 40 hours versus 5 hours? It's just we managed to do a lot more of this. If people say, oh, we read the same annual report, we just managed to read a few more than our competitors, and I think that's how you get to the understanding. So if you then try to translate what I just outlined to maybe your personal perspective is how many stocks should an individual cover? Like if you think about, like we have 25 stocks in the fund, 5 of us, on average we cover 5 stocks. That's it. Like we don't cover 15, we don't cover like 10 or 20 stocks. So if you have to ask yourself, like if you ended up with, I don't know, more than 5 stocks in your own personal portfolio, like have you actually managed to spend enough time to do it? I mean, obviously, I mean, you could easily invest into other fund managers or the ETF, the different markets or indices, etc. But then I think if you're talking about stocks, which is something very specific, that I think the work that's required to go behind the scene is a lot more than you think. And even for professional managers like us, I mean, we are doing 5 per person on the team, and then that's how we get a conviction. I probably don't have time to go through some of this here, but I mean, I already outlined that if you use Microsoft as a proxy, being a very high quality businesses, then there's just less things to worry about. Like they have very strong competitive positioning. There's no competitor in their space that's worth to consider, or that can disrupt their business. And then the other thing is that if you look at the earnings growth trajectory for Microsoft, which I got a chart here, you can't see this, but if you come to my stand, I will probably show it to you. So there's this chart here, you see 2 lines. One is the red line, one is the blue line, right? And what you have here is since October 2020, the red line is the share price. So the share price of Microsoft has gone down about 15% over the last 3 months. But what we really focus on from Blue Whale perspective, and what I'm trying to outline here, is the blue line. The blue line is the consensus forecast for Microsoft earnings 2 years from today. So you can use that as a proxy in terms of the earnings growth trajectory for Microsoft. So if you believe this blue line is going to continue to go up or not being impaired, then you could argue that the share price has made the share price reset has made the valuation cheaper, right? Depending on your time horizon, can it become even more cheaper? It could, but it's definitely cheaper than before. In contrast, I just give this example as well. I recently talked about this in some interviews, that this is the same chart, but for a different company called Peloton. If you follow this home bike company that costs you about $2,000 or £2,000, that when we have the lockdown, you can't go to the gym, you sit at home and then you cycle, and you need to pay them a subscription fee as well. The same period since October 2020, the share price has gone down by 80%, and then the blue line has equally gone down about 60% as well. And then if you look at how much cash they have burnt over the last 12 months, they have burnt over $2 billion in the last 12 months to December. And look at how much cash they have got left on the balance sheet, only $1 billion. And hence it was rumored that maybe Amazon or Nike are going to acquire them. And recently, if you follow what happened to Peloton, is they have extended the trial period from 30 days to 120 days. So you can actually try out the bike for 120 days before you refund, if you decide to. And then secondly, they have also now reconsidering whether they need to sell, whether they want to sell a bike for $2,000. Maybe they should just make it a subscription. But they're quite desperate in a way that basically the business model is broken. So I think that is all these things that you want to avoid, and this is what we have got on here. And obviously, Microsoft has a very strong balance sheet. Like they recently spent about $70 billion to acquire Activision. I mean, you would think like that's quite a lot of money. Maybe it's expensive acquisition, but then that $70 has been set on Microsoft balance sheet doing nothing for shareholders. Its earnings accretive, etc., etc. The other thing, which I probably don't have time to go into too much details, is like how do you then go into valuation? I think the one thing that we do for every company that we have in the fund, we would construct a unique financial model. So we will make forecasts in terms of how much money this company is going to make in the next 3 to 5 years, which I just outlined, that we don't use the consensus number. We try to come up with our own numbers. And how you can then use translate the numbers as a proxy, that whether we have a differentiated angle versus the market. That's very important, because like you can't invest into shares that everyone knows what this company is going to deliver in the next 3 to 5 years, and there's no differentiated angle, and then you can't outperform the market because the market is efficient. So I think doing your own forecast, and then if you can then use the market as a proxy to say, oh, the market expects this company is going to make $100, we're going to expect 120. If we are right, then that's a differentiated angle. Obviously, then you need to go into the nitty-gritty in terms of whether the assumption is coming differently versus the market, etc. And I'll give you one example. If I have time, let me just check. Okay, I don't have time for the example, so come to see me later. But I think valuation is important. The other thing is we look at free cash flow yield adjusted for debt. So that is the one valuation metrics that is very important over 5 years. And then the turnover is very straightforward, like any deterioration in fundamentals, we would exit. Valuation less attractive, we're trying to find something more attractive. We only invest into about 25 to 35 companies. The universe is about 100, and so if there's a better opportunity to come, we want to go into that. That's the performance. I'm sure you can find this on the website as well. That's what we have done over the last 4 years, different calendar year basis. That's the return, including the recent sell-off in the market. The fund is down about, including this week, is about 15% year to date. But over the medium term, we've analyzed about a lot more than the average global fund in the market. So the last slide is like we are just at M45 and 46. If you want to follow us on Twitter, you can. We have a price draw today. If you want to scan this QR code or you want to scan that at our stand, you're welcome to.